Let me ask you something uncomfortable. You spent 12 years in school, maybe 4 more in college. You learned algebra. You memorized historical events. You wrote essays. You took exams. But did anyone ever sit you down and explain how to make your money multiply? Did anyone show you how to build a 7-figure portfolio? Did anyone break down how compound interest can quietly generate millions over time? Probably not. And that's not your fault. The education system teaches you how to earn money. It does not teach you how to build wealth. There's a difference. Earning money requires effort. Building wealth requires strategy. And most people graduate knowing only the first half of the equation. So they do what they were trained to do. They get a job. They earn a paycheck. They pay bills. They save a little. They repeat. And they assume that someday, somehow, financial freedom will just happen. But here's the truth. Income alone does not create wealth. What you do with your income determines everything. Today, I'm breaking down the investment strategies that should have been mandatory knowledge before you ever received your first paycheck. This isn't hype. This isn't financial advice. This is financial literacy. And once you understand it, you'll never look at money the same way again. The real reason most people never build wealth. The biggest mistake people make isn't earning too little. It's waiting too long. Investing feels complicated. Feels risky. It feels like something smart finance people do. So people hesitate. They think, I'll start when I earn more. I'll start when I understand everything. I'll start when the market feels safer. And while they wait, time moves forward. And time is the single most powerful force in wealth building. Let me show you something powerful. 2 people are 25 years old. Person A invests $200 per month starting today. Person B waits 10 years and begins investing $400 per month at age 35. Person B invests double the amount every month. Who wins? Instinctively, most people say Person B. But they're wrong. Person A started earlier. And because of compound growth, Person A often ends up with significantly more wealth by retirement, despite investing less total money. That's the power of time. And schools never taught you that time matters more than intensity. Strategy 1. Own the market, don't chase it. One of the biggest myths in investing is that you need to pick winning stocks. You don't. In fact, trying to pick individual winners puts you in competition with hedge funds, algorithms, and professional analysts. That's not a fair fight. Instead, you can own the entire market. This is called index fund investing. When you invest in an S&P 500 index fund, you own a small piece of 500 of the largest companies in America. Apple, Microsoft, Amazon, Google, and hundreds more. You're not betting on one company. You're betting on economic growth. Over the past 50 years, the S&P 500 has averaged around 10% annually over long periods. Not every year. Some years are down. Some years are explosive. But over decades, the trajectory trends upward. Now let's run numbers. If you invest $300 per month starting at age 25, and you average 10% annual returns, by age 65, you could have roughly $1.9 million. You personally contributed about $144,000. The remaining $1.7 million? Compound growth. Your money earning returns. Then earning returns on those returns. Then earning returns again. That's not speculation. That's mathematics over time. Compare that to leaving money in a savings account earning 1%. Inflation alone erodes purchasing power faster than that grows. That's why saving alone doesn't create wealth. Investing creates wealth. Strategy 2. Use the tax system to your advantage. Another concept rarely explained clearly is tax-advantaged accounts. Let's talk about the Roth IRA. With a Roth IRA, you contribute money you've already paid taxes on. But once that money grows, the growth is tax-free. Forever. If your investments grow to $1 million, you don't owe capital gains tax on that growth when withdrawn properly. That's powerful. Now consider a regular taxable brokerage account. Over decades, taxes can quietly eat away hundreds of thousands of dollars in growth. Tax efficiency is not exciting, but it is wealth accelerating. Then there's the 401k. If your employer offers a match and you're not contributing enough to get the full match, you are literally rejecting free money. If they match 5%, that's an immediate 100% return on your contribution. There is no stock on earth that guarantees that. Wealth builders think differently about their paycheck. They don't view it as spending money. They view it as capital, a tool. They pay themselves first by investing automatically before lifestyle expenses expand. Strategy 3. Asset allocation over time. Wealth building is not just about investing. It's about adjusting intelligently. When you're young, time is your shield. If the market crashes at 25, you have decades to recover, so you can afford to invest aggressively in equities. Stocks historically outperform bonds over long periods. But as you age, preservation becomes important. Gradually shifting into more stable assets reduces volatility risk as retirement approaches. Target date funds automate this process. They adjust risk as the retirement year gets closer. That's simple infrastructure. No constant monitoring required. Building wealth is like planting a tree. In the beginning, you water aggressively. You allow it to grow tall and strong. Later, you protect it from storms. But if you never plant it, there's nothing to protect. The mindset shift that changes everything. Most people frame investing as trying to get rich. That framing is dangerous, because rich feels abstract, far away, unrealistic. Instead, frame investing as buying freedom. Every dollar invested is a future employee working for you. Imagine reaching a point where your investments generate $2,000 per month. That could cover rent, or groceries, or your car payment. Now you're not financially trapped. You have options. You can leave toxic jobs. You can reduce hours. You can pursue meaningful work. Wealth is not about luxury. It's about optionality. Financial independence means your life decisions are no longer dictated solely by income. And that shift in perspective makes long-term investing meaningful. Why most people quit before it works? The biggest barrier isn't knowledge. It's impatience. People invest for 1 year. They see modest growth. They think it's too slow. And they stop. But compounding is backloaded. The majority of wealth accumulation happens in the later years. The early years feel slow because you're building momentum. After decades, momentum becomes exponential. That's why starting early matters so much. You are not expecting dramatic returns next year. You are building infrastructure for 30 years from now. The simple action plan. Let's make this practical. Step 1. Open a Roth IRA or traditional IRA depending on eligibility. Use reputable brokerages like Vanguard, Fidelity, or Schwab. Step 2. Choose a broad index fund or target date fund. Keep it simple. Step 3. Automate contributions. Even $50 per month is powerful if consistent. Step 4. Capture full employer 401k match. Step 5. Increase contributions when income increases. Redirect raises into investments before lifestyle expands. That's the entire system. No secret hacks. No day trading. No prediction games. Just discipline plus time. The truth about small amounts. Many people say, my contribution is too small to matter. But small amounts multiplied by decades become large amounts. Run your own compound interest calculations. Plug in realistic numbers. You'll see that consistency outweighs intensity. Waiting for the perfect time costs far more than starting imperfectly. You can adjust strategy later, but you can't recover lost years. The long-term game. This is not a get-rich-quick strategy. It is a get-rich-slow strategy. And slow wealth is stable wealth. Fast money often disappears. Slow money compounds. The education system prepared you to earn, Now you must prepare yourself to build. Because wealth isn't built through luck. It's built through ownership. Ownership of businesses. Ownership of market growth. Ownership of your financial future. You don't need to be wealthy to begin investing. You need to invest to become wealthy. Small, consistent contributions. Tax efficiency. Index funds. Time. That's it. No misteri. No hidden formula. Just math and discipline. And the sooner you start, the more powerful it becomes. Welcome to Freedom Fund Mastery. Your financial education begins now.